Welcome back, everybody. Today, I thought a great way to kick off the final trading month of 2024 would be to analyze the Dow 30 stocks in order to figure out which stocks look like a good deal going into the final month of 2024 and which stocks are overpriced. So, in the next few videos, I'm going to be taking 10 of the Dow 30 stocks and quickly analyzing them, just looking at their basic ratios, starting with, of course, Apple, ticker symbol AAPL, which is a technology and hardware company with a current market cap of $3.59 trillion. If we take a quick look at the price to sales ratio of Apple, we can see that it's trading at 9.31 times sales versus a 5-year average of 5.61, meaning Apple is trading at a premium to its average of 66%. This is quite overvalued on a long-term basis. Looking at earnings per share, it's currently trading at 39 times its PE ratio, which is quite a bit higher than its 5-year average of 23.19 times, 68% higher to be exact. And if we take a look at the chart here, we can see that the current fair value for Apple coming into the end of the year would be approximately $156 per share. And even into 2026, by the end of 2026, we expect Apple to be worth $192 per share if we use its average 5-year PE of 23.19. With the stock currently trading at $237 per share, we can see it is quite a bit overvalued even for the next couple of years. Price to EBITDA reflects much the same at 58% overvaluation. Price to EBIT, or earnings before interest and tax, is 57% overvalued. Apple's price to free cash flow is marginally better at only 40% overvalued. And the company's price to book and price to tangible book is overvalued by 76%. If we take a look at the company's 5-year dividend yield average versus its current dividend yield of 0.41%, we can see that it's 50% overvalued based on its 5-year average dividend yield. And to read this chart, anything above the black line here would be considered a good deal on a dividend basis. Anything below the black line would be considered a bad deal. So with Apple trading at 0.41, which is about the lowest its yield has been ever in the last 5 years, it's probably a bit overvalued at this point. The company's enterprise value to EBITDA is also overvalued, again, by 57%. The current EV to EBITDA ratio is almost 28 versus its 5-year average of 17.77. So again, this company just more and more looks like it needs a pullback. But just like the price to free cash flow ratio, the company's enterprise value to free cash flow ratio is the best looking of all of them, only overvalued by 39.4%. And then taking a quick look at the company's drawdowns, Apple is currently at all-time highs with a current drawdown of 0%. Looking through the past 10 years, we can see that quite regularly in about 2 to 3 year intervals, Apple draws down about 30 to 35% with a max of 34.86% in 2019. So it is something that we can expect to see this company draw down quite often, 10 to 20%, and then every now and then 30%. So up to you if you want to buy at all-time highs. That's never necessarily a bad thing, but certainly with its overvaluation, along with the fact that Apple is at all-time highs, I would caution starting a position in this company. And finally, just a few what I call X factors to look at. The first one here is the 5-year expected growth rate on earnings per share of 9.52%. This is certainly nothing to scoff at, but it is not anything impressive either. The company's price to earnings over its growth plus yield, essentially how much you can expect earnings plus dividends to pay you over the next several years, is 3.93. That would be considered quite high. Anything below 1 would be exceptional. Anything depending on the company from 1 to 1.5, maybe if it's a defensive company up to like 2 is an okay number, but 3.93 is quite high. And the same thing goes for enterprise value over free cash flow divided by growth plus yield. This is essentially just the PEGI ratio, but taking a look at enterprise value instead of the market cap price, and then looking at free cash flow instead of the company's earnings and doing the exact same thing. This number is 3.26, which is slightly better, but still much higher than where we'd want to see a company that we want to purchase, around that 1 to 1.5 mark. The next stock on our list is AMZN, ticker symbol AMGN, and this is a healthcare company that works in the biotech space and has currently got a market cap of $152 billion. AMZN does currently trade at a discount to its 5-year average price to sales. The current discount is 7.81%, so it's not huge, but it is something. On an earnings per share basis, the company's been struggling recently with relatively flat EPS and a major dip happening recently, although analysts do expect that the earnings per share for the company recovers quite quickly. So by 2026, with an average price to earnings of 21.85, we would see that AMZN is worth $463 per share versus its current price of $283 per share, which would suggest significant upside on an earnings per share basis. The company's EBITDA has also been flat for quite a while and is currently trading at a 15% premium to its price to EBITDA over the last 5 years. And with the drop in earnings, AMZN's EBIT, or earnings before interest and taxes, has also taken quite the hit. So the company's currently trading at a 47% premium to its long-term average EBIT. But as long as earnings recover quickly, as analysts expect, this premium should close not because of the stock price going down, but because of the company's EBIT increasing. The same can be said for free cash flow. The company currently trades at a 41% premium to its 5-year average free cash flow numbers. Although, again, this is a result of poor earnings over the previous year or two. If the company is able to recover as analysts expect, we should see this premium decrease to fair value or maybe even a discount. When analyzing price to book value, AMZN is basically fair valued right now. If we take a look at its tangible book value, all of its numbers are actually negative. So it's just how the company does accounting. So there's not really much that we can garner from the tangible book value. On a dividend yield basis, AMZN again is looking quite fairly valued with a current yield of 3.14% versus its 5-year average of 3.06%, representing just under a 3% discount to its long-term average. The company's enterprise value to EBITDA numbers are about 19% overvalued. But again, if the company is able to bring those EBITDA numbers back up in line with where analysts expect, we should see this premium start to close quite quickly. Same can be said about EV to free cash flow. There's a large premium currently, although I don't expect it to remain that way for much longer as long as analysts are correct in their predictions. And taking a look at AMZN's drawdown chart, we can see it's currently in a 16% drawdown, which is pretty much in line with the highest quartile drawdowns that the company experiences in general. So if you're going just purely based on stock price drawdown, this might be an interesting time to start taking a look at AMZN. The company can draw down all the way to about 25%. It did draw down 24.5% in 2023, and that is the largest drawdown that it's had in the last 10 years. But as you can see in the chart here, it very rarely gets to that 15% number that is currently hovering at. So this is a decent time as from a drawdown perspective to take a look at AMZN. Finally, to take a look at the X factors, the company is expected to grow by 5% per year on an earnings per share basis. For a biotech company, that is nothing spectacular, although AMZN is quite large for a biotech company. If we include the 5-year expected growth plus the yield that the company currently pays at about 3%, and we divide the price to earnings by that ratio, we get a number 4.43, which, as explained with Apple, is quite high, and we would prefer to see this number closer to 1, maybe 2. Same can be said for EV over free cash flow over the growth plus yield. With a score over 4, this company does look like it is just better off being left alone for the time being. Either let the company's valuations come down or its growth prospects go up, one or the other, but currently does not look very favorable from a valuation perspective. Third on our list of companies is another one of the Magnificent Seven, that is Amazon Inc., ticker symbol AMZN. This company, as many of you probably know, is a discretionary retail company, and its current market cap is $2.19 trillion. The company is a bit overvalued on a price to sales basis, currently trading at about 3.5 times sales versus a 5-year average of 3 times sales, leading to a premium of about 17%. We're going to ignore the earnings per share just because of how my calculations work. The 5-year average earnings per share is negative for Amazon, so it just messes up the whole graph. Other valuation metrics are quite strong for Amazon. And that includes the company's price to EBITDA, which is on average 23 times its EBITDA, but is currently sitting at only 19.9, representing a 14% discount to its long-term fair value. Price to EBIT looks even better, currently 39% discounted from its 60 times normal price to EBIT value versus its current price to EBIT of 36. The company's price to free cash flow is overvalued by about 18% again, but its book value is 21% undervalued on a 5-year basis, and its tangible book value is 31% undervalued. Amazon does not pay a dividend currently, and its enterprise value to EBITDA ratio is currently sitting at 20.56 versus its long-term average of 24, representing an approximately 15% discount. EV to free cash flow looks terrible on the graph thanks to some major swings in the free cash flow numbers for Amazon, but it is currently sitting at a 13% discount. And when we look at the 10-year drawdown chart, Amazon is currently in a drawdown of 0.14%, essentially at all-time highs. And it is not super often that this company draws down more than 20%. As we can see, it's only happened 4 times, and in 3 of the 4 instances, it didn't stay down 20% for very long. The company's largest drawdown, of course, came in 2023, hitting a peak of approximately 55% down from its all-time highs. And finally, as far as X factors are concerned, Amazon is our first really good looking company with 23.19% expected 5-year compound annual earnings growth, a PE to growth plus yield, or in this case, just PE to growth ratio of 1.92, which is quite good, especially for a company that is as large as Amazon, and a free cash flow over growth plus yield ratio of 1.82, which is even a little bit better. So we see that on a earnings and free cash flow basis, Amazon is in a decent buy area currently. Next is American Express, ticker symbol AXP, which is a consumer finance company well known for its credit cards and has a current market cap of $214.63 billion. This company is currently trading at a 46% premium to its long-term price to sales, and it is at about a 27% premium to its long-term price to earnings ratio. Although, as you can see coming into 2027 here, the fair value of the stock would be about $305 per share, where it's currently trading at about $304, $305. So you could say that Wall Street is currently pricing in earnings over the next couple of years, and growth can make up for that premium. Due to how earnings and ratios work with financial companies, I'm not using EBITDA, so just as a heads up, you're not going to see those numbers here. But on a price to EBIT ratio, we can see that even then, American Express is overvalued by about 30%, currently trading at 17.31 times its current price to EBIT versus the long-term average of 13.34. On a free cash flow basis, the company's trading at a 44% premium, again, quite high. Price to book value is at a 58% premium, and price to tangible book is at about a 36% premium. American Express does trade at about a 35% premium to its long-term dividend as well. The company's enterprise value to free cash flow is at about a 30% premium. But on the bright side, for any long-term investors in American Express, it's currently at all-time highs. Though I would caution that in the last 10 years, we have seen this stock draw down about 45% on 2 occasions and a 30% drawdown on a third occasion. So this company is quite capable of facing some large drawdowns. And then taking a look at the final X factors here, we have a 13.22% expected 5-year compound annual earnings growth, which is pretty good, especially for a financial company. This leads us to a PE over growth plus yield value of 1.59 and the enterprise value to free cash flow over growth and yield of 1.22, which are both pretty solid numbers and are the lowest that we've seen so far. Number 5 on our list is the Boeing Company, ticker symbol BA, which is an aerospace and defense company with a current market cap of $116 billion. Now, really quickly, just know that this company is in some really terrible financial conditions right now. A lot of my charts are just not going to look good because of that. Checking out price to sales, the company currently trades at a 32% discount to its long-term average of 1.93 times sales. That's for good reason. The company's price to earnings ratio over the last 5 years has been negative most of the time because the company's been losing money. So my graph here is all out of whack with an average price to earnings of negative 79. The company's price to EBITDA also is quite crazy right now, with an average of 243 as the company's price to EBITDA, due to the fact that the company's been making very, very little money, very low EBITDA numbers, which has skewed the average to be incredibly high. Same story in price to EBIT. The company's EBIT has been negative for basically all of the last 5 years. So all the averages are negative. The graph just doesn't make any sense. Same story for free cash flow. The company's book value is also a negative value, which is never a good sign, as well as its tangible book value. And Boeing did pay a dividend 4 years ago, but in 2020 they cut that dividend in part due to the pandemic, and also in part due to the fact that the company has just been bleeding money ever since 2019, 2020. So we see that at one point there was dividend information, but now it's all zero. Enterprise value to EBITDA, again, equally skewed, and the same can be said about enterprise value to free cash flow. But the one piece of information we can get a little bit of information from is the drawdown chart, and where we see that Boeing's 10-year drawdown, the company is basically stuck around a 40 to, let's call it 75% drawdown right now. And it's just been hovering in that area ever since, currently at a 64.72% drawdown. And so taking a brief look at all of our X factors, there's a 6% compound annual growth expected. That is when the company does finally get a positive earnings per share, which is expected to happen by the end of 2025, although those earnings per share are expected to be less than $1 per share. The PEGI and the EFGY ratios are both green because technically my rule is set up for anything less than 1 to be green, but because they're negative, again, it's just data is being skewed by the really poor financial results for this company. And I think it goes without saying, Boeing is probably a company that you should avoid unless you're feeling quite speculative. Our next Dow Jones stock is Caterpillar Inc., ticker symbol CAT, which is a heavy machinery equipment company with current market cap of $196 billion. CAT currently trades about 60% above its long-term price to sales average of 1.92. It's currently trading at 3.05. On an earnings per share basis, the company looks much better, trading at only a 12% premium. But again, we see a bit more overvaluation when we look at price to EBITDA, which is at about a 36% premium over its long-term average of 9.34. The company's price to EBIT is at a 22% premium, and its price to free cash flow is at 16.8% premium. Taking a look at the company's price to book values, where it gets especially ugly at about a 61% premium, and its price to tangible book value is about a 33% premium. Caterpillar does pay a very steady dividend, but its long-term average of 2.38% is much better than its current yield of 1.33%, which represents a premium of 44% to the long-term average. Caterpillar's enterprise value to EBITDA is, again, a little bit overvalued at 28% premium, though when we look at the free cash flow compared to its enterprise value, that is only a 9% premium. So there are valuation metrics where Caterpillar looks like an okay buy today. Taking a look at his 10-year drawdown chart, Caterpillar is in a current drawdown of 0%, aka at all-time highs, like many stocks today, but we can see that the stock regularly draws down to 10 to 15% and quite often can see much larger drawdowns of 30, even 40%. So this is a company that can be a bit cyclical. And if we take a look at the final three X factors here, we can see 9.51% expected compound annual growth to the company's earnings, which is fairly solid. A PE over growth plus yield ratio of 1.74, which again isn't amazing, but it's certainly okay. But when we look at the EV over free cash flow, it's 3.03. So again, Caterpillar has certain metrics where it looks okay with at, and other metrics where it looks clearly overvalued. So kind of depends on how you want to value the company and its long-term growth prospects. Number 7 on our list of the first 10 Dow Jones Industrial stocks is Salesforce, ticker symbol CRM, which is an application software company with a current market cap of $315 billion. Salesforce does currently trade at about a 20% premium to its long-term price to sales. And if we take a look at the earnings chart, due to some very, very high earnings per share ratios early on in the company's trading, it has a very skewed average. It's certainly not worth 379 times its earnings. Fortunately, the price to EBITDA chart looks much better, and we see that it's about a 19% discount to the company's long-term price to EBITDA of 42 times. It's currently trading at about 34.5 times price to EBITDA. Much like price to earnings, our price to EBIT numbers are quite skewed, and so this isn't very helpful. On a free cash flow basis, Salesforce is trading at a little bit of a premium, about 11.5%. And when taking a look at the company's book value, it's trading at nearly a 41% premium, though that premium does come down quite a bit when we take a look at the tangible book value, which is only 7% overpriced. Salesforce does not currently pay a dividend, and if we take a look at the long-term EV to EBITDA ratio, it averages about 45 times EV to EBITDA, and is currently trading at 35.5 times, which represents about a 20% discount. Looking at free cash flow numbers, though, Salesforce appears to be trading at a small premium of about 9%. And finally, taking a look at the 10-year drawdown chart, we can see that currently it's sitting in a drawdown of 3.5%, basically near its all-time highs. And generally, this company does not draw down more than 20 to 25, maybe 30%, although in 2022, we did see a much larger 60% drawdown. But taking a look at the final X factors, there is about a 15.5% compound annual growth rate expected for Salesforce. That gives us a PEGI ratio of 3.71, which is not great. But if we take it on a free cash flow basis, we see the free cash flow yield is 1.57, which is much better. So much like Caterpillar before it, Salesforce is a company that can look like a good deal in certain metrics, can look like it's quite overpriced in other metrics. So you're going to have to decide if the growth rate and the current premiums that it trades at are worth potential multiple compression. And up next is the legacy communications equipment provider Cisco Systems, ticker symbol CSCO, with a market cap of $235 billion. Cisco currently trades at a 15% premium to its price to sales. And although it is trading at a 37% premium to its price to earnings ratio over the last 5 years, if we look at the analyst expectations for future earnings, we do see quite a big jump in the earnings per share for Cisco, which would explain why the stock is trading at a premium now. Based on 2026 numbers, the stock should be worth about $73 per share and is currently trading at $59 per share. So that, based on the earnings, that is a decent time to buy Based on company's EBITDA, though, it is trading at a 29% premium. Again, if earnings do go up as much as they are expected to, this should increase as well. And by this, I mean the company's EBITDA, which would make that premium disappear. Same story can be said for price to EBIT. Again, trading at a 38% premium, but that could quickly disappear if the company's earnings per share increases significantly as they're expected to. On a free cash flow basis, Cisco is trading at a 7% premium, which is a much better deal compared to the earnings ratios. It is also trading at only an 8% premium to its price to book value over the last 5 years. But its price to tangible book is very heavily skewed due to the fact that its average tangible book value over the last 5 years has been negative. If we take a look at the company's 5-year average yield of 3.11% and compare that to its current yield of 2.69%, we would see that the company is trading at about a 13.5% premium on a dividend yield basis. And on an EV to EBITDA basis, Cisco trades at, again, about a 35% premium. Once again, though, when we take the EV and compare it to free cash flow, we see that premium gets much smaller, currently sitting at 12%. And Cisco as a company is coming out of some of its worst historical drawdowns in the last 10 years, reaching as low as about 35%. It looks like 37% as the low in 2022, which was only matched just barely by a 38.5% drawdown during COVID. Currently, the company sits at a negative 6.5% drawdown, so it is nearing all-time highs once again. And finally, to take a look at some X factors here, the company is expected to grow at 4.28% per year for the next 5 years, which is quite a bit slower than a lot of the companies we've been looking at. Its PE over growth plus yield is sitting at 3.65, which again is not great. And even when we take a look at EV to free cash flow, which is some of Cisco's better numbers, that still looks a bit high at 2.74, largely due to the low growth expectations. So Cisco clearly seems like a relatively safe company to own. It's not too terribly overvalued, especially if you take into concern the future expectation of earnings, but this isn't a fast-growing company at all. Our second to last stock is a recent favorite of Mr. Warren Buffett's, and that is Chevron Corporation, CVX, which is an integrated oil and gas company with a current market cap of $291 billion. When we take a look at this company on a price to sales ratio, it is basically trading at fair value, a small 3.35% premium. On an earnings per share basis, it is about 8% premium, but we do see that expectations for earnings in the future are to go a little bit higher. So by 2026, we expect the fair value for this stock to be $216 versus its current trading price of $161. So with that growth in mind, it is expected that the company be trading at a slight premium today. On a price to EBITDA perspective, again, Chevron is basically right at fair value, trading at a slight 1% discount. And when we take a look at EBIT, these numbers are highly skewed due to the fact that the company struggled, especially in 2020, due to the pandemic and how oil prices crashed. So the average price to EBIT of 3.82 is just quite low. That's not realistic. So we will ignore this. On a free cash flow basis, the company is trading at a little bit more of a premium, about 15% at 21.5 times its free cash flow versus the long-term average of about 18.7 times. Again, when taking a look at book value, we do see a slightly higher premium of about 14%, and tangible book value again also at about 14%. Chevron does yield a fairly high dividend with a 5-year average of 4.46%, but the company does only yield 3.95% right now, which would represent a premium of about 11.32% over its long-term average. When taking a look at enterprise value to EBITDA, this company is right smack at fair value with a just super minuscule premium. But once again, when free cash flow gets factored into the situation, it is trading at a slight premium of about 16% here. And when we take a look at Chevron's drawdown chart, we can see that it is trading at a current drawdown of 13% off of its all-time high. The company has been hovering around a 10 to 20 or 25% drawdown lately and is capable of drawing down 40% and even over 50%. As we can see, it's done 2 times in the last 10 years. Finally, for the company's X factors here, it's growing at 6.2%, which is quite fast actually for a large oil and gas company. And this gives us a fair PEGI ratio of 1.76, which compared to many of the other stocks we've seen is quite low and is pretty decent. And sticking with the theme for Chevron, when we factor in our free cash flow, it looks a little bit worse. It's about 2.22, but again, this isn't terrible. It's not super high like we've seen other companies. So all in all, Chevron is a pretty fair deal today. You're not getting a great deal on the stock, but you're also not overpaying for it. And our final Dow Jones stock of the video is the Walt Disney Company, ticker symbol DIS, which is in the movie and entertainment sector and currently has a market cap of $212 billion. On a price to sales basis, this company is undervalued at about a 19% discount to its long-term average of 2.9 times sales, but its 5-year Average EPS is skewed very heavily by a couple of down years that it had following the pandemic. So the 50 average is a bit too high for this company, and we should ignore that. Although the company is probably trading at a minor discount currently, even on an earnings per share basis. When looking at price to EBITDA, Disney is trading at a 36% discount. And on a price to EBIT, it's trading at a 55% discount, which, again, I do want to caution is skewed slightly by the fact that there were some really poor years that made these numbers, the average is much higher than they would normally be. But as I said, for earnings per share, I do think that Disney is probably trading at a slight discount to its fair value currently. When we look at price to free cash flow, the company is trading at a 21% discount, and it's trading at a 13% discount to the company's book value. Tangible book value has also been quite sporadic over the last 5 years, so we can't really use this number either. And Disney at one point did pay a very strong and consistent dividend, but due to some issues with the company as well as the pandemic, they were forced to stop paying that dividend. They paid it again for, I believe, 1 quarter, and then again they cut it. I would expect Disney to start paying a dividend in the future, but they do not currently pay one now. When taking a look at the EV to EBITDA, Disney's trading at a 33% discount. So again, this is probably slightly skewed, but the story is the same. Disney's probably slightly undervalued. Using free cash flow, we're looking at a 17% discount. And when we take a look at the company's drawdown chart, we can see that Disney is in the midst of a huge drawdown, largely due to the lack of profitability that came following the pandemic in 2020. So there's still plenty of overhead room for this stock to fly higher if the company is capable of turning around and returning back to its pre-pandemic profitability, which I think is probably an inevitability in the long term. So taking a look at the final X factors, Disney does have a very solid growth expectation of 13.84% for the next 5 years. And that gives Disney a PEGI ratio of 3.12, which isn't great, but if we factor in maybe a dividend coming into the future, we could see that PEGI ratio fall sharply in the next year or two. And the same can be said for its enterprise value over free cash flow compared to the growth in yield. At 2.42, it's a little bit high, but if Disney were to start paying a dividend anytime in the near future, we would see that number fall quite precipitously. So all in all, I think Disney represents a decent mini turnaround opportunity if that's what you're interested in. And with that, those are the first 10 Dow Jones industrial stocks that we've looked at today. Of the 10 that we looked at, I think the two most obvious stocks that look like a decent investment today based on their numbers is Amazon, AMZN, and American Express, AXP, with a runner-up to a few other companies like Cisco, Chevron, and Disney that all have a few things that look okay and a few things that look a little less shaky. But if you made it all the way to the end of this video, thank you so much. Please leave a comment down below if you want me to go in depth on any of these companies. Please do not forget to like the video and subscribe to my channel. And with that, I hope you guys have a wonderful evening. Bye.